Hey everybody, this is Mitch Ferraro from F Street. I hope everyone's having an amazing day out there today. I'm super excited to have this conversation as always. I have Matt Hamilton on from Hall CPA. This is actually our first episode where we're actually doing it via Zoom. So, Matt, I really appreciate you coming on today from the virtual world. This is awesome. We're super excited. And I've got Matt on today because I want us to have a better understanding, and I want to give our investors a better understanding of what is it like to have a CPA on your team. And he's going to give us some information about, tax advantages and what it's like to be an investor and have these tax advantages. I actually just recently had an awesome experience. Matt was at our investor summit, basically presenting to all of our investors at the summit, and he did an amazing job of explaining tax benefits and how someone like a CPA like him can help you as the investor basically navigate the IRS code and the tax code for real estate investments. So Matt, thank you so much for coming on today. You guys, if you see me looking up, Matt is like right above me on our screen. So I'm gonna be talking to you guys, talking to Matt, but Matt, thank you so much for coming on today. Before we get started, Matt, I would love for you to just give our audience an understanding of who you are, what you do, and we'll go from there.
Yeah, no, thank you for that introduction. Happy to be here virtually and kind of have this this virtual fireside chat as it were. But like you said, my name is Matt. I am a senior manager at Hall CPA. We are a fully remote virtual tax firm that specializes in real estate. Our domain name is actually therealestatecpa.com. So we have some prime virtual real estate there with that domain. But we primarily focus in real estate, and my team specifically, we focus with our larger real estate operators. So, for example, like clients like F Street. Where they have multiple syndications and they're kind of putting together these deals and raising outside capital. We really come in and provide some insight into structuring, getting all of those properties set up in different LLCs, getting K-1s out to investors, helping on the back end with answering questions from investors, and just kind of providing that all-around tax support for larger operators such as yourselves.
Yeah, and I think what's really cool about someone like Matt and his team is, we don't know the CPA side of the business. We know the development side of the business, the private debt fund side of the business, and I think that's what's always really important, that you have the experts that you can lean on for these types of structures and understanding the tax code. So I'm really excited to have this conversation. Matt, I just want to, start off, right off the bat. What do you see as being some of the best tax advantages of being in real estate when it comes to like being a limited partner in a structure of like one of our multifamily deals or one of our industrial deals? Just start off by giving us a little understanding of those advantages.
Yeah, absolutely. So when you're looking at various asset classes as investments, each kind of have their own pros and cons. And one thing that's very unique to real estate, especially in today's environment with some of the recent changes in tax law over the last 5, 10 years, is whenever you invest in real estate, it's obviously an income producing asset. It's by no means entirely passive. Obviously, real estate takes a lot of work to, become cash producing, but it's a cash flowing asset. But for tax purposes, you're allowed to take all these paper losses against that income. Whereas if you were to buy a stock or invest in bonds, you're going to receive dividend and interest payments, but there's no, paper loss to offset that income. So it becomes a very tax efficient investment from that perspective, just because of the depreciation component that you're able to take advantage of.
Yeah, so let's dive into depreciation a little bit. I want you to go through that and just what does that even mean to our investors and how does that even work?
Yeah, no, that great follow-up, because that's the immediate follow-up I always get to that statement. So depreciation is kind of what I referred to earlier. It's a paper loss, right? So it's a loss that doesn't actually exist. Really, what it's allowing you to do is, let's say you buy a building for $1 million. What the IRS effectively allows you to do is deduct that $1 million investment over time as an expense. And what that has to do is it's supposed to correlate with the wear and tear of the property. So obviously buildings age, they need to be fixed up, they deteriorate over time. That's what that depreciation is supposed to reflect. I've always found that kind of weird personally because that makes sense on paper. But the thing about real estate is that it generally appreciates in value. So you
Right?
have like on paper, like the value is going down because of wear and tear, but realistically the value's usually going up. So it kind of creates this discrepancy over time. But that's kind of what depreciation is supposed to represent from a tax perspective.
Yeah. Now, tell us a little bit about how an investor can take advantage of depreciation from doing an investment like some of our multifamily or industrial developments. Give us an idea of how they might be able to take advantage of that.
Yeah, absolutely. So one thing that I actually do want to get into before we kind of dive into the more nuanced piece of that is what I was saying earlier, you buy a building for $1 million, you depreciate the cost. But whenever you buy a building, you're not just buying the property, you're buying the land, you're buying the roof, you're buying the windows, the doors, the floors, the refrigerators. Like every individual piece of that building is what you're buying.
Yeah.
So what's often done, it's sort of industry standard, especially with larger commercial real estate, is you have what's called a cost segregation study performed on the property. And that's
Yep.
sort of it's an engineering based study. So basically what they do is they have someone go out to the property and they say that, you know, 1% of the value of this property is related to like, I don't know, the carpet or like
Yeah.
some all
Right.
these like individual components and it breaks it down. And the reason why that's relevant is because for tax purposes, each of these individual components have different depreciable lives. And
Sure.
that matters a lot because anything that has a depreciable value of less than 20 years is eligible for bonus depreciation, which is
Okay.
this this fun term that's been thrown around a lot over the last 10 years. It was really brought about with the Tax Cuts and Jobs Act back in 2017.
Okay.
And it basically just allows you to take a bunch of additional depreciation on those certain types of assets, those 5, 7, 15-year assets like appliances, carpet, um, furniture, fixtures, all those other what's considered personal property.
Okay.
Um, and that bonus depreciation phased out over time, but now we're in this environment. Now we have 100% permanent bonus depreciation, meaning that anything that has that shorter depreciable life, all of those smaller components, you can deduct the entire value of those components in year one, which creates
Okay.
this huge tax loss up front.
Right.
So for multifamily, for example, if you do a cost segregation study, you're looking at anywhere between 35% of the entire purchase price of the property immediately deductible in year one, which creates these
Wow.
huge tax losses whenever you're investing in these larger properties.
That's huge. I mean, and I think to try to get an investor to wrap their heads around is that you as the investor are going to be able to see on paper, because we do provide you a K1 at the end of the year, on paper that there's this loss with you being a limited partner in one of our deals that you can use against other passive income that you're actually getting from other investments. Let's talk a little bit about those passive losses that an investor can take advantage of. Give us an idea or just tell us a little bit more about, K1 comes in at the end of the year and you're going to get a passive loss. What can that investor do or how does that work for an investor with that passive loss?
That's a great question. I always like to refer to it as flavors of income. So whenever you're looking at taxable income, it comes in two primary flavors. There's passive income and
Yep.
non-passive income. The tax
Yep.
code specifically uses the phrase non-passive. Just to make this more conversational, I'm just going to call it active because it's easier to differentiate. So passive and
Yep.
active income.
Yep.
Um, Active income, that's your W-2 income. Obviously, you're going to work every day, you're actively participating in creating this income. Unfortunately, they also consider interest and dividends and other portfolio income as active income. You know,
Yep.
super unfortunate, but it is what it is.
Right.
By default, real estate is passive. Now, why does
Yep.
all this even matter? This matters because passive income or excuse me, passive losses can only offset passive income. So if you're generating these real estate
Correct.
losses, they can only offset your passive income, meaning you can't just take these real estate losses and offset your W-2 income, your interest income, your dividend income, which kind of creates a challenge. There is a way, there are two primary ways to make that real estate activity active, not passive, and that's through the short-term rental loophole and becoming a real estate professional, which we can kind of pull on those threads if you think that's relevant. Those are some hoops you can jump through to make that active, but by default it's passive. So if you're going to be receiving, these K1s from your passive investments, giving you these passive losses driven through depreciation, you can't just go and take that and deduct it against your W-2. If it were that easy, everyone would be doing it. So that's kind of how that shakes out whenever you're receiving those K1s.
Yeah, how I always kind of look at from just my personal experience is, I have investments here at F Street with our syndication side. I'm a limited partner in our deals. And I also have rental properties, right? Single family homes that produce income every year. The passive income that I produce through the rental properties, I can combat the passive losses that I'm getting on the deals that I have with our industrial acquisitions or our multifamily developments. I can use that to combat the passive income that I'm coming in. Am I looking at that the correct way?
Yeah, absolutely. That's one of the things because like whenever I say that, you can't use your K1 losses to offset your W-2 income, a lot of people say, "Well, that sucks. I'm just not going to do that." But to your point, the benefit is time because if
Yep.
you start making these passive investments, you get these huge hits of depreciation up front, but eventually those are likely going to stabilize into income producing assets and you're going to start receiving passive income on those
Yep.
K1s.
Yep.
And once that starts happening, then you can start thinking to yourself, okay, well, how do I make this passive income go away? Well, I can make another investment. And then you kind of get into this cycle where you're investing more, you're getting depreciation to offset your passive income from previous investments. And what you
Yep.
end up having is what I like to refer to as this wealth building flywheel, where now you're creating all of this income and you're offsetting it with losses from new investments. So you're
Yep.
effectively growing all this wealth and creating all this income for yourself over time. And most of it isn't being taxed. So you're keeping it all in your pocket, which again goes back to that tax efficiency that
Yep.
is available to you via real estate that isn't necessarily available with other asset classes.
Yeah, let's give investors a thought too, right? So let's say it's their first investment in a K1 passive loss type of scenario, and they don't have anything to combat that passive loss that they are showing. What do they get to do with it?
So if you don't use it, you don't lose it. It's not use it or lose it. So if you invest, let's say you invest $100,000 in a commercial real estate deal and you get just back the napkin math, you get $30,000 of losses in year one. You don't have
Yep.
any passive income. So what happens is that $30,000 of losses gets suspended and carried forward on your tax return in perpetuity until you have passive income to utilize those losses. So if you don't have anything to utilize it for in year one, not a huge deal. You're just going to start kind of creating this arsenal, if you will, of all these built up losses that you can use to offset future income.
Yeah, so I think that's a huge, huge point right there for our investors, especially if you're a newer investor trying to figure out, how can I take advantage of something like this if I don't have any passive income yet? You will once you start making those investments and those investments go down the road. And basically, you're able to then offset as you are starting to make more and more and more passive income through those initial investments that you make. Matt, correct me if I'm wrong here. The way that I always looked at taxes is that you're kind of in these types of scenarios is you're kind of just kicking the can down the road, right? You're kind of just you're gonna have to pay it possibly at some point, but just how long can you wait to pay that gain or pay those taxes? Is that mindset kind of correct that way in these types of scenarios?
Yeah, I mean, timing is everything. When it comes to tax strategy, 90% of it is just timing and
Yep.
pushing income and deferring it and recognizing income in years where you have lots of losses to offset it. It's all just kind of being in control of that timing. But to your point, that deferral, it gives you that time. It gives you that
Yep.
flexibility because it's much easier to plan to offset $1 million of income 5 years from now than it is to figure out how to offset $500,000 of income every year, right
R-
now, next year.
Right.
And like it kind of changes the way you go about planning. So yes, it eventually it all comes to unless you pass away and then you just get this
Right.
step up in basis for your heirs, And I always joke saying that the ultimate tax strategy is to just simply die,
Yep.
and just get one over on the IRS. But
Yep.
outside of that, eventually everything comes to fruition and there is a taxable event eventually. It's just controlling that timing.
Yeah, that's how I always kind of thought of it. I'm building this wealth for the generations that come after me. I may not be able to see the ultimate benefits of the wealth generation, but at the end of the day, that's not my main goal. My main goal is to kind of build a legacy, and help those that come after me. Because at some point you're gonna have to pay it unless you said like you pass away, and you can defer that, all of it when it goes on to your legacy behind you. As we're kind of talking about that a little bit, from your experience, right? You're a CPA. What do you see some of the more savvier investors? Who else do they have kind of on their team to help kind of build this legacy? As they grow older and trying to make the right investments. I would just like to tap into that a little bit on who else are you working with maybe sometimes for the more savvier investor besides just the investor themselves?
Yeah, that's a great question. And it obviously kind of depends on the individual and what their specific needs are. Most commonly, I see people working with a separate wealth planner. Our firm specifically, we are not wealth planners. There are some CPA firms that do both. So
Yep.
kind of as you're talking with people, sometimes you see that scenario, but outside wealth planners, estate planning attorneys, those are very common.
Yep.
Um, if you're more involved in real estate and kind of have your own portfolio, it's always encouraged that you have an attorney on hand as well to kind of
Yeah.
draft up those LLCs and all those other pieces. It really depends on your personal situation, but I'd say the most common group of people I see a lot of successful investors have on their team is a CPA, an estate planner, and an attorney.
Yep.
Sometimes the same person fills multiple of those roles, but
Sure.
that's sort of the trifecta that you want to have.
Yeah, yeah, I think that's very important. Like I said, you want to lean on, you want to do what you do well, and maybe that's investing, or maybe that's being a CPA, and then kind of leaning on the experts for these other pieces. Yeah, it may cost some money to do those things, but at the end of the day, if you're making the right investments, if you're doing the right things, those costs should be, you know, very small compared to what you're trying to build and do. Um, you know, Matt, before we get out of here, I want to just try to touch on a little bit about current trends that you're possibly seeing and going through. There's a lot of stuff going on with the IRS right now and different tax codes and the big, beautiful bill. Can you just give us, I know that's a super loaded question, but can you give us some trends that maybe you're seeing or some tips that you're seeing right now to our investors that might be able to maybe utilize some of these tips that you might be able to have?
A lot to touch on in that one question, but if you'll take a walk with me, let's kind of go back in time. Let's do a little bit of
Sure.
story time here.
Let's take a
So
little walk.
back in the first Trump administration, they passed the Tax Cuts and Jobs Act, which created this 100% bonus depreciation environment, and that dramatically shifted the way that real estate operators and investors were making these larger investments in different properties. They were more aggressive, especially in an environment where there were really low interest rates. Cash was just flying everywhere.
Sure.
Prices were rising, like real estate prices were rising exponentially. It was a very lucrative environment where a lot of people were jumping in. Fast forward a couple years, that bonus depreciation was phasing out. The idea was that it would decrease by 20% until it hit 0% in, I
Yep.
believe, 2027. So bonus depreciation was phasing out, interest rates were rising, and things were starting to sort of clam up a little bit. There was
Sure.
less investment, and what you found was that a lot of syndicators that got into the market when things were going very well, things were very easy. A lot of investors were finding that their syndication deals were not going super well. They
Yep.
found out that the $100,000 they invested in with some new syndicator in 2019, 2020 just completely went belly up. So it was creating this environment where a lot of people were losing a lot of money as things were tightening. And that affected some of our clients. It affected a lot of people in the industry, and I'm sure some of your listeners are, are probably relating to this, unfortunately, with maybe with some other investors that they were working with. But now things are sort of shifting again, where now they just Congress just passed the big beautiful bill, which brings bonus depreciation back up to 100%. And now that's permanent. It's not phasing out. It's
Yep.
100% in perpetuity, with
Yep.
the asterisk that, Congress could, pass another bill that changes that at any time. So,
Right.
it's as permanent as anything can be. But that's really radically changing the environment again. So it's not coupled with super low interest rates like it was back in 2018, 2019. But it's all kind of coming back. So that's kind of the changes in tax law and how it's impacting investors. And then the other side of that is the IRS. So the IRS, under the Biden administration, there was um, a lot of funds being allocated to the IRS to increase enforcement and update their systems. And to be clear, the IRS desperately needs funds to upgrade their systems because they have like entire cafeterias full of banker boxes of documents that just haven't been reviewed. Their systems are like based on like Windows 98. Like it is super outdated and it's so difficult to get anyone on the phone. They desperately need the funding. Um, and not just for enforcement, just to make everyone's life easier when dealing with the IRS, because love them or hate them, everyone has to deal with the IRS. So making
Right.
that experience as painless as possible is,
Yep.
in my opinion, a worthy investment. But other folks disagree. A lot of that funding went away, and now we're sort of back to the IRS really reducing enforcement and kind of struggling for some of that funding. So we never make recommendations or give tax advice based on audit risk.
Sure.
So
Sure.
you should always be doing everything above board, but the IRS is struggling with enforcement at the moment, and I don't foresee that really changing anytime in the near future. So that's kind of the story of where we've been over the last 5 years and how we've gotten where we're at.
Yeah, I mean, you summed it up very well. Like again, I know that was a super loaded question to say, hey, what's going on with the IRS and how can we take tax advantage with what the code is for the IRS? And you were able to sum it up very, very well. I think biggest point that I took out of it was 100% bonus depreciation for right now we can foresee it until they might change it, which is huge. Again, this is very huge for investors that are in our syndication deals. Very, very interesting enough, right? So we have like basically two sides of our business. We have the syndication deals, our industrial acquisitions, industrial development, multifamily development, and then we have our private debt fund where we loan money out to real estate investors with hard money, through hard money. And that right there, that's if you want to say like passive versus active, the private debt fund is an active investment. You're getting an interest payment every month. So at the end of the year, you're receiving a 1099 INT. You cannot use your passive losses against the private debt fund. As much as that would be cool to do, we can't do that. And then there's the other side of the business, right, where it's the syndications where you're going to be receiving the K1s at the end of the year, where you can combat other passive income. Again, if you do it the first time and you don't have anything to combat that passive income against, you can use it until you start having those passive gains. So, Matt, my man, thank you so much for your time today. I really, really appreciate it. I think this is some super valuable information for our investors. Is there anything you want to part ways with before we get out of here today?
No, I think I really appreciate you having me on. I do wanna shout out. I'm a co-host on the Major League Real Estate podcast, and we just had both Scott and Josh from F
Yep.
Street on the show over the last 3 weeks. So those were really great conversations. If you want to hear more insight from like the way that Scott and Josh sort of think about, you know, the business side of F Street and kind of
Right.
dealing with investors, looking at potential properties and acquisitions and all of that, super interesting conversations there. So I'd encourage you to give those a listen as well.
Yeah, absolutely. I 100% agree with that. If you guys want to hear direct from the mouth of our owner and founder, Scott Lurie, and one of our other principals, Josh Lurie, go check it out. Where can people find that, Matt?
It's on Apple Podcasts, Spotify, SoundCloud, anywhere where you happen to listen to podcasts, we are there.
All right, awesome. And what's the name of it again?
It's called the Major League Real Estate Podcast.
All right, go check it out. Guys, we're here. We are very educational, as you can kind of see. Go check out these podcasts, learn more. At the end of the day, I always give kudos to our investors or anyone that's possibly investing with us, because at the end of the day, it's up to you to do your due diligence, to build your financial wealth. And these types of podcasts, this type of information, we're trying to help you do that. So again, Matt, my man, thank you so much for your time today. I really, really appreciate it. And I hope everyone has a great day.